Capital Discussions. My name is Himanshu, and everything that we do here is purely for educational purposes only. We are not a broker-dealer. We don't deal with anybody else's money. We merely teach. So now let's begin. Most of you, as I said earlier, have already seen this presentation. I believe Tom did put it along with the original presentation that Jim and I made on the 30th of April, I believe. And you guys can always download it from there should you want it, or you can email me and I can send you a version if you like. So I'm not going to go through this entire presentation per se. I just wanted to show you some. Now you have already seen this part here. We had our 2013 results. We had our 2014 results. And then I showed you a trade that we did last year during December, where the market really moved up and down big time. And then I had shown you the results of 2015. This is not a back test. This is live results. And some of you who are on the trial actually had these results already. We did two Kevlars in SPX, then we did two more in the rut, and then we added one more in SPX. So the first two, which are closed at the SPX August trades, that's these two right here. And essentially, this concludes my presentation. I just wanted to show you what we have so far. We are going live with the service starting today. And as Tom just mentioned, somebody had a question about how a Kevlar can be protected should there be a, 3, 4, 5, 6 standard deviation move in the underlying instrument, whatever it is, a RUT or SPX or whatever it is. Now, I'm assuming that whoever asked the question to Tom was asking how we can protect ourselves if something like this happens within a day. Now, we have seen in fact, just yesterday, there was, at one point in time, the SPX and the RUT both were down by 2.3 standard deviations. So if we can reach all the way to 2.3, 1, 2, 3 standard deviations more really shouldn't matter much. But one good thing about the Kevlar is the fact that our T+0 line usually is very straight, like this. This is an ongoing trade in the SPX right now. And as you can see, in this case, our T+0 line is pretty good. Our deltas and gammas are within the range. In other words, even if there was a 3 standard deviation move, somewhere in the middle, when our deltas go out of whack, we would adjust. Another good thing about all iron butterflies and iron condors is the fact that if the price is moving down big time, one of the best things you can do is just get out of your short puts and write out the short calls and the long puts. So 3 standard deviation move probably would be about more than 50 points, in which case our long put down here will start making us money, and as long as you are out of this one, you are okay. Our short credit spread on the calls will, of course, make us money, and because this was in the money to begin with when we started, remember, when we actually, if we do a Kevlar in steps, so for example, if you were to sell the call credit spread and the put credit spread, you will have noticed that when we sell the call credit spread, we get a credit of anywhere from $27 to $29. So if we have a massive down move, we have ample time to get out of the short put credit side completely and let the call side make us money. If we get to keep the entire $27 that we took in at the very beginning, then we would do very, very well, right? Again, it all depends on the speed of the movement. of the underlying. For example, if there is a 3 standard deviation move in 1 hour, then it doesn't matter what trade you have on. You are going to get killed. And the best thing that you can do at that point in time is just deal with individual legs, single contracts or single, buy, sell, a call or a put, and just get out of the short puts. That is what I would do. There may be other ways of dealing with things, but hopefully that answered the question. And whoever did ask that question to Tom, if you need any further clarifications, feel free to send me an email or give me a call. And here's another question from Larry. Larry, when an adjustment alert is made and I can't get a fill at the posted price, and I can't get a fill at that price in a reasonable time, should I take whatever price I can get or wait it out? Oh, yes, I remember, Larry, you had asked. In the rut, Larry could not, we sent out an adjustment yesterday morning in the second rut trade. These are our current rut trades going on. In the second rut trade, this is September. Hold on. This was a trade that he couldn't get filled from 240 to 230. I believe this was it, or maybe it was on the put side. I don't really remember, but whatever it was. So for example, if we are doing something to bring our deltas up, meaning let's say it is -8 right now and we want to bring it somewhere close to 0, and I say, do something. And if you don't get filled at that point in time, it really doesn't matter, because I try to make sure that our deltas don't get so out of whack before even doing the adjustment. Most of our adjustments are almost proactive in nature. We don't say, okay, damn, my delta is now -20, therefore I should do something. If my delta is, even go closer to 10, I will actually do something. So many a times, you can wait it out. You can just keep the trade going on. Remember, by default, every single time that we make an adjustment, give yourself plus or minus 30 cents. So whatever price I send you, if I say, okay, make this adjustment for a credit of $4.40, you can literally go down to $4.10, maybe even 4. Because ultimately, if your deltas are in alignment with whichever way the market is moving, you won't get hurt too much. Does that answer your question? So most of the times you can more or less, in fact, many a times I have waited for like 3-4 hours, especially if I decide to do an adjustment, let's say at like 10:30 in the morning. Then I may put the trade on, and the trade is still sitting there at, say, around 2 o'clock in the afternoon. At around that time, maybe I'll shave off 10, 15, 20 cents and see if it gets filled. If I really, really want to get it done, then I will say, you know what, I may even shave off $1. But most of the times, even if you shave $1 off, in the final analysis, as long as your deltas are within range, let's say, and in alignment with whichever way the market is moving, you really shouldn't worry too much. That's one of the reasons why, in fact, there are 2 reasons. One of the things, we managed to make 6.42% in 26 days and 14 days. Usually in my trades, my personal trades, I tend to stay in it much longer because I want to make a higher return. But, I can risk my money in various ways. I would prefer not to risk yours as well. But down the line, what we can do is take some profits off. And the real reason why we did this is because, remember, we had only 2 contracts that we went in with. Over here, sometimes I had 6 contracts, 7 contracts, 8 contracts. So I try not to go beyond 6. So I'm starting to peel off, and I may leave the last 2 for a much longer duration of time to actually increase my overall returns. So you can do it that way as well. And if you want to do it that way, let me know, and I can sort of send out an alert which says, if you want to do it this way, then hang on to the last 1 contract or 2 contracts. Make sense? Barry? Oh, there was another, Ron has a question. In the email, Ron, shouldn't you just get on the phone and ask these questions and prevent me from reading all this stuff? So Ron is asking the email alerts you send out, apart from sending a screenshot of the matrix, it would be great if you could also include a screenshot of the risk graph as well. Certainly, sure, no problems. I can definitely do that. In fact, Tom has set up another area for specifically for trade images. So what I can do is that place specifically reserved for images, and there is a description there as well. So I can say that, you know, this is the adjustment that we are doing on the 7th of August at this point in time, and this is what the matrix is supposed to look like, which will show you the trade that you do. And after you do the trade, or before even you do the trade, this part here will, so for example, if I say do this, then you will see this part as well as this part with the existing position as well as the modeled position. Make sense? That's a great idea, Ron. No problems. I can do that. Al is asking, can you talk about how much the service is? It's the same standard price, $119 a month, $300 for a quarter, and some more discounts if you go 6 months or a year. Oh yeah, and that was, Dick actually asked me a question whether, and Tom, if you are here, this is for you. Dick asked me a question whether we would be okay charging just $1,000 if somebody wants to sign up for the entire year. And I'm okay with that. Is that okay, Tom?
Yeah, that's on that page where you can sign up. That you have options for 1 month, 3 months, 6 months, or a year, and it's just per month. The more time you sign up for it.
Oh, okay. All right. So there you go, Dick. That answers your question.
Himanshu, this is Ralph.
Hey, Ralph. How are you?
I am good. How are you doing?
I am doing very well.
Good. Say, got a question. You have a sweet spot for entry on this thing, but I see people trading it all the way down to, 8 to 14 days. How do you feel about the intermediate, 30 days, 45 days as far as an entry on some of these?
In my back testing and even in my live trades, I have gone as close as 21 days.
Okay.
And the farthest that I have gone is 92 days. And both of them worked out very well. So yeah, but of course, remember one thing, the closer you are, you may actually end up doing more adjustments.
Oh yeah, yeah.
So if you are doing RUT and SPX, and if you have the standard contract of $1 or less, it really shouldn't be a problem. But I was also trying to do this, and on options on the E-mini S&P futures, where each option contract to go in and come out costs you $5. So there, I decided to stick to my 60, 65 days out, because doing too much of that, $5, and if you have like 20 contracts, you could get in trouble just from commission.
Oh, you bet. It eats your lunch, for sure. Thank you very much.
Oh, no problem. Okay, here are some more questions. Larry is again, this is the same Larry, Larry West. Okay, so Larry is asking, hold on. Oh, that's a lot of, okay, Carl is saying, can you provide a link to the original presentation, and Tom actually put that trade on, the link on. Larry is saying, how many open trades should we expect at any given point in time? The number of open trades will vary. You need to use some discretion on your own side, depending on how much money you want to actually put in this trade, and depending on your account value and everything. Personally, in my own account, I have had, and again, I have many different accounts, so depending on that. But in my largest account, right now I have the 2 RUT trades, I have 2 SPX trades for September, and I have an SPX and RUT trade for October on as well. So again, it depends, but normally we will try to make sure that our planned capital is about 10K. And then what you can also do is that should you prefer to not just use 10K but use more, but have less trades, you can go, let's say, you can say, for me, I will have a planned capital of 20K, and you just double the number of contracts that I am showing you here, and make sure that you remember the fact so that when the adjustment comes, you double the number of contracts at that point in time as well. So you can sort of extrapolate up and down. But normally we will start with 2 or at the most 3 contracts and no more. But you can go, this can be scaled up to, especially with the SPX, you can go with 1,000 contracts. Because if you get filled, it could be a significant amount of time. Make sense? So the open trades normally, just for the sake of simplicity, we will probably have 1 trade in SPX, 1 trade in the Russell, and probably an additional trade in SPX PM, which is essentially SPX, but it just the settlement is on Friday evening instead of Friday morning. So probably 3 or less. Then the next question is, with the IV going up, as the RUT keeps crashing, our Vega short position on Kevlar seems to be high. Correct, but remember what Ron's presentation showed us? Vega, the number that you see here is not really the number that will affect your position. It could be about 1/10 of this number. Even now, as you can see, while the Vega or the VIX is increasing, our P&L has been going up since 9:30 this morning. So remember, the main thing is to make sure that your delta is sort of aligned with the way the market is moving intraday, or if not intraday, over the, a day or 2, so to speak. But most of the times our delta will be so close to 0 that we are depending purely on theta. And as you can see, our gamma is also very less, which means that even if there is a huge move in the market, our delta is not really going to go out of whack too much. And that is the main goal. The main goal of this trade, again, the main goal of all trades, remember that the preservation of capital is our first motto. And the next is to make a little bit of money. And if things really go south or too fast north, our goal is to lose as little money as possible. And as you can see, since we started our trade, in fact, the trade that we started our first trade in SPX on the 26th of June. Since then, the market has gone down by about 3 standard deviations, gone up by about 4 or 5 standard deviations, gone back down by another 3 or 4 standard deviations, gone up 2, gone down 2. In fact, just yesterday was 2. And today is close to 2. 1.17 already today. And we really haven't done much. We just made sure that our deltas were more or less where we wanted them to be, and the rest just took care of itself. Make sense, Avi? All right, so the next question is from Dan. It would be great if the alerts also contain a brief reason for the adjustment. Correct. Now, remember, I think, Dan, I did tell you once, there are 2 ways that I send out my alerts. One is this, the SMS text thing, where I have a very small number of characters, something like 123 or something like that. So over there, if I add any extraneous characters, then when I actually place the copy of the trade itself, it gets truncated. So in my SMS text, I'm just saying, do this. Then I actually send out an email, and in the email, I'm writing, our delta is too negative, therefore we are doing this, or our delta is too positive, therefore we are doing this, etc. If you see the emails, it is very possible that in some of the emails I may have forgotten to mention why we are doing this, but I will try to remember. Okay, again, Al, how does this compare to the M3 in terms of ease of adjustments? To be very honest, I think it is extremely comparable to the M3 because I tried the M3 as well. In fact, this thing came about when I was backtesting the M3, and what happened was that I had a calendar in the SPX already. And the other thing also is the fact that if everybody out there is trading the RUT, you will find me trading the SPX. And if all of you suddenly move to SPX, I'll probably move to NDX. And I do that unconsciously. So now remember, John Locke actually says that M3 on SPX, doesn't really give the same kind of results per se that it gives in the RUT. But the entire premise of this trade is almost identical to the M3, where we are looking at the Greek trends, as John Locke calls it, which is why we are saying if our gamma is like this, we know that our delta is not going to really trend up or down too much, right? As opposed to let me show you, as opposed to this. As opposed to, let's say, a calendar, and this is just, look at this, this is just a one contract calendar, and look at our gamma, it's -5. Which means that if the underlying moves from 2.38 to 2.28, my delta is going to go significantly positive. It's just going to go from 12 to 18, literally. So as long as I'm aware of what the gamma is going to do to my delta, I know how to now manage. So if this thing really starts moving down big time, I will go ahead and add something else down here. Of course, this is the calendar, which none of you are interested in. So let's go back to the other one. So my entire thing is, and it took me 15 years to reach this stage, I only do 2 trades right now. I will do the M3s because I want to sort of, get into the habit of doing it often enough so that it sort of crystallizes into my head, so that even if you wake me up from deep sleep and ask me what to do, I'll know what to do, as I do in the calendars and the Kevlar. But essentially, these are the only 2 trades that I do for a living, calendars and the Kevlar. And they both sort of, mitigate each other's. They are complementary to each other in the sense that my calendars are always delta positive, as we know, preferably, not necessarily all the time. If I see the underlying really moving down by 3-4 standard deviations, I'll make sure that my delta turns negative, even in a calendar. And by default, in the Kevlar, my deltas are always negative in the first place. In the first, the Vega is positive, here the Vega is negative. So all in all, my what is it called, portfolio Greeks are more or less delta neutral and Vega neutral, and my theta is twice as usual because both of them are helping me. Of course, the gamma gets out of whack because of the calendars sometimes. Look at this. This guy is also, the one is also doing some weird things lately. Look, we just made 80%. I think I should go back and forward again. Okay, this is much more reasonable. All right, well, let me see. TOS seems to have challenges with the analyzed tab. TOS seems to have more challenges than the analyzed tab lately. But I agree, the analyzed tab in TOS was, it's like the most basic analysis option that you have out there, and you have to like sort of jump through hoops to make sure that it actually looks at your previous adjustments as well. In fact, that was one of the reasons that I decided to use this, because, and of course the other reason was that when I send out adjustments, I can actually send you a picture which tells you what it is that you are supposed to do. It's easier for you guys and easier for me as well. So yeah, I, for the longest time, all the way up until 2013, I only used the toss tab. But then remember, up until then, most of the times I was only doing calendars. When I'm doing calendars, I don't even need to look at the graph, because it's like I've done them for so damn long that I know exactly what to do at any given point in time. Make sense? But yeah, I agree. The toss analyze tab is essentially, if you are doing four-legged trades, it is essentially a useless tool. I mean, you know, as a last resort, you can use it, but it still won't give you the real P&L and the rest of the stuff. In fact, if I remember correctly, Avi, I sent you an Excel spreadsheet, not an Excel spreadsheet, a Google sheet. That will actually tell you a whole lot more than the analysis tab in TOS. It'll give you the precise P&L at any given point in time. Well, not any given point in time, but literally after every adjustment that you make. Much more simpler to use and very handy when you need to send a massive list of trades to the IRS at during tax time. And I actually go out of my way to I print out all those, every single individual trade, meaning in this case it will be 4 legs, so it will be 4 lines. Every adjustment will be 1 additional line. And then in my Schedule D, I actually say various, and I attach this entire big Excel spreadsheet and I send it to them, because I want them to, you know, have a lot of trouble going through the damn thing. Seems to work. They don't really contact me too much. Okay, so Tom is saying 160, yeah, okay, sorry, not 123, 160 characters. That's still, you know, very little for the whole thing. Well, there was a lot of questions. In fact, this is about the most questions that I've been asked so far. Anything else? Nothing else?
Hey, Himanshu, this is Ron again. I was just curious, would you be willing just to show your thinking or logic in setting a trade up in terms of if you had to place a new one on today, just as an example? Because I know that the standard Kevlar is, you know, the 50-point wing on the left and the 40-point wing on the right, but you seem to kind of sometimes go between that and an unbalanced left leg and right leg. And I was just curious, you know, if you have.
Oh yeah, sure. Yeah, no problem. For example, today, and this is even better in the sense that today is a big down day. Usually, putting on iron butterflies and iron condors on down days is a good thing to do, because we are hoping that it will go back the other way and our negative vega will help us. So, for example, if we were to put on a trade today, and let us suppose that we were to put on a trade, I don't know, just for the heck, because Ralph did ask me this question. Before I continue on, somebody is asking me about futures. I'm currently a futures trader. Can you? Yes. Well, you trade currency futures. Okay, so usually this particular trade works very well when you get a massive amount of credit, which you get when the underlying is, $1,000 or $2,000 or in the case of NDX about $4,000. Most currencies are around, 100, 200 max. So while it will still work, the amount of credit that you will take in will be significantly less. But from a percentage perspective, you should get the same P&L percent as you would do on these trades. Makes sense? And yeah, so Ron, sorry about that. And because Ralph also asked whether this can be done, 30 days or less than 60 days. So just for the heck of it, I'm going to show you something that is a weekly or August expires 14 days from now. So this is probably another weekly or some other kind of trade. But you can, let's say, okay, 30 days, right? So 28 days out in September. This is a weekly September, expires on 4th of September. So in this particular case, if you were to start a new trade, we would go approximately to a delta of 37-ish, between 35, 37 plus minus. Again, you will spec it out first to make sure that your deltas are not overly leaning to one side or the other. We know that the market is going down. Yesterday, who the heck was I talking to? Yeah, I was talking to my group for calendars where I said that after a 2 standard deviation move, there is almost a 92% probability that the next day the market will continue to move down, which it did. And now we are another minus 1.09 standard deviations today. So if I were to go to, say, we are at 70, a 37 delta is 45. I don't like to do the fives or the numbers that end in fives unless it's a 25 or a 75. So in this case, I would probably go to, let's say, a delta of 40. And let's say here we do 40 and 50 point wide would be 90. So this is the put side. We are getting a significant amount of credit, $10,400. And now we go to the call side, and I would go to 40 here as well. And if I say 10, and suppose for the sake of argument, we are going to stick to a 50-point wide wing. So 40 to 90. If I do this, then my delta is minus 125. So it's the slightest up move, and I am underwater, right? So I would not want that. So let's say what happens if I come back here to 2080. In other words, we now have a 40-point wide wing. And now my delta is minus 60. Even this is a little too much for me. So we can say, what instead of 10, what if I were to do 8? Well, this looks a whole lot better. My T plus 0 line on the downside is more or less, straight, and I'm or maybe even slightly leaning up. On the right side, I'm okay with the T plus 0 line leaning down slightly because I know that my Vega is going to help me if this moves to the right. So right now, today, if we were to place this trade, this is how I would place it. Exactly in this one. Make sense, Ron?
Yep, thanks.
Okay. So here's a question. I can't seem to read the name. PJ Log. Oh, okay. One of my guys. By that I mean he's also an Indian. What is the most important factor you look for doing this trade? Well, the most important factor is a very straight T plus 0 line. We know that in most income trades, that is by far one of the most important factors. Unless you are a very, very good directional trader. In which case, you can say, hey, I think this damn thing is going to go down a lot, and I'm okay with my delta being minus 120. But if you are really a good directional trader, why even bother with iron condors and iron butterflies? Just buy a damn put. I mean, that's what I would do. You know, you will spend a whole lot less in commissions, and you will make a significant amount of money. Right? You can just buy an out of the money put, and that put goes in the money, and you know, your P&L just explodes in a positive way, of course. So one of the most important things is a straight T plus zero line. The other is, as we learned from John Locke, is the gamma trend that, essentially the gamma trend, but you are looking at the trend for the all the Greeks. And of course, the gamma trend will determine the delta trend. We already know that as you come closer to the expiration, your theta will keep on increasing as long as none of your short calls or puts are too much in the money. So what this thing actually does, this trade actually will keep your theta in check as well. I don't know if any of you have heard John Locke when he said that just because you do something and your theta explodes and becomes 3 times as it is right now does not necessarily mean that it's a good position to be in. So you have to make sure that your theta is more or less in sync with your delta. I mean, a lot of people look at the delta theta ratio. Lately, who is this Brad Wood? Oh, Brian Johnson. Yes, that's the book that Dan Harvey had mentioned and Brad had mentioned. So if you read that book, you will find that that gentleman, Brian Johnson, looks at this different ratios, the delta theta, the delta vega, the theta vega, all these different ratios, and he will adjust the position to make sure that all those ratios are within a certain range. That is another way. That is, you know, like trading purely by the Greeks. You can do that too. I, for some strange reason, can't seem to trade purely by the Greeks. I just have to look at the damn chart because I started out as a technical trader. I still am a technical trader. And I'm hoping that it'll bounce off the 200 on Monday morning. Or not. We are okay. If we put this trade on, I'm perfectly fine if it doesn't bounce off. But if it does bounce off, I'm okay. If it does not bounce off, I'm still okay. Make sense? So the most important factor that you look for doing this trade is to make sure that if the market moves in a direction that you did not anticipate, you still don't get killed. That is the most important factor that you have to look for. Actually, that is a factor that you have to look for in any trade that you put up. So the next question is, can we combine directional with a neutral strategy too? Yeah, of course you can. In fact, most of my calendars are bullish calendars. And as you can see, by default, most of these Kevlars are slightly bearish butterfly. And most of the times, especially in SPX, I have a bearish Kevlar and a out-of-the-money call calendar, which is bullish. Remember, that's what I just said. My entire trading is now, you know, sort of crystallized into 2 things. I do bullish calendars and bearish butterfly. That's it. I don't touch anything. I don't do diagonals. I don't do double diagonals. I don't do ratio spreads. I definitely do not do the holy trade.
Hey, Himanshu, your adjustments so far in the advisory have mostly been either, you know, peeling when you've got profits or rolling shorts around. So if we were to get a big move and we got, you know, past the edge of the tent, and let's say your Vega on the upside becomes positive and, you know, your Theta comes down to nothing, what are you doing on the upside? Do you roll? Do you add another butterfly? What's your strategy there?
This guy's talking right now. I'm going to meet on the 22nd today, no, 22nd of this month.
Okay, who the heck is that?
That was Ron.
That was David. No, Ron asked the question, but there was some other voice going on in the back. Yes. So essentially, let me see if I understand your question. You're saying that, let's say, just for the sake of argument, you were talking about the upside. So let's say we have like a 2 standard deviation move to the upside, and we are all the way at 2120. So there's a 50-point move to the upside over the next, say, 2-3 days. And my theta actually turns negative. Then what would I do? Well, long before we get that move, remember, even if we get that move in one day, there'll be a time during that day when our deltas will, in this case, if you go all the way over here, our deltas will only be at minus 22, which is not too bad if you have 10 contracts. But in this particular case, if the price is moving up, if I'm looking at the chart and we are seeing a bounce off the 100 as has happened quite a few times, and if my theta is negative, then what I will do is I will roll. Of course, if the market moves up, if SPX moves up big time, this delta that I sold at a delta of minus 34, actually we sold it at 35.7, and now it is 34.92, which is very strange because the damn thing has come down a bit. This delta will go down to like maybe 15 or 12. Then what I will do, and of course, if the market is moving up, my delta will also be turned significantly negative. So long before my theta actually goes down to a negative value or even 0, I will have moved my short put spread up. So I will have, when I take this off, I will have made a profit. And I move it up and sell it off, sell it again for significantly more or less, or maybe the same amount of credit, or slightly less, depending on where I put it. And I will put it preferably around a delta of, again, 35-ish. So the original start conditions apply when we take off the entire credit spread and reposition it up or down. Make sense?
Okay, so you're talking about the put side, so the call side, you would roll that as well, so you're essentially rolling the entire Kevlar up? Is that what you're saying?
No, I'm only rolling the put side up first. And after doing that, if my deltas are again in sync, because remember, when I roll my put side up, even though my theta is negative, it will turn positive because I just sold a 35 delta put, correct? So my theta will again be back positive. My delta is in sync. My gamma will remain, as long as my gamma is, I want my gamma to be greater than -2 or less than +2. And sometimes in this trade, the gamma actually turns positive as well for a, brief periods of times. It's pretty nice. You always, it's very rare to get a gamma positive in an income trade. Now, if I move this up and my deltas and my theta are not where I want them to be, then maybe I will take 1 or 2 of these contracts and roll them up as well. Now, when I do that, I will be incurring a loss, slight loss, right? Because this is already in the money right now. If the market moves up by another 20, 30, 40 points, this will be deep in the money, and I'm essentially not making any theta at all, which is why my theta turned negative in the first place. So when I take 2 or 3 of these and move it up, also at a delta of 60. See, right now, when I do it, this is around a delta of 65. This is at a delta of 35. If this delta turns to, say, 99, I'll take it off, 2 of them, if not all of them. I will start peeling them off. So if I take 2 off, then I will incur a loss on my call side. But I'm not concerned because the amount of credit that I took in is so large. Look at this. My total margin is 19,456, and I have taken in $30,000 in credit on this trade. So I'm okay with using some of that money that I just took in as credit to get out of my call sides, 1 or 2 contracts, and move them up in order to get my Greeks back in, alignment. So, am I making sense? Sort of?
Yeah, I think I understood. So basically, it's a three-phase adjustment. The first phase would be rolling shorts. Second phase would be rolling the put side up. Third phase would be rolling up the call side, more or less.
Provided we get a huge move, yes.
Right. Cool. Thank you.
No problem. So which is a very low-risk strategy, calendar or pure play on getting as much as intrinsic value by hedging? Well, I am obviously the wrong person to ask this question, especially because you use the word calendar. A calendar, if you do it right, and I just showed you a calendar right now, didn't I? If you do a calendar right, oh, okay, these are, just go to PS. This is one of my all-time favorites, along with IBM and SPX and the RUT, for trading calendars. This is a trade where we literally haven't done much at all, but we are up by 17.96%. Actually, we were up by 20%. We had two contracts. We took one off. We had a triple calendar. Now we only have a double calendar, so we took a significant amount of profits off as well. And on top of that, we are reducing our commissions or margin from 21.38 down to 6.95 down to the in the left-hand corner. And two more rolls, and we will reach a stage where this trade cannot lose, even if Goldman goes to 1,000 in 3 days, or it goes down to 0 in the next 3 days. So yeah, the calendar is the trade. Let me put it in very simple ways. If somebody were to put a gun to my head and say, put on a trade and it needs to make money, I would put on a calendar. On the other hand, if somebody says, you can put on any trade that you want, but except for a calendar, and the gun is still at my head, then the trade that I would put on is the Kevlar. Does that answer your question, PJ? So remember, a low risk, there is no such thing really as a low risk strategy. It is a low risk plan. How you trade is what really makes a trade low risk or high risk. It's not the strategy itself. It's how good you are at implementing the strategy. And we are all good in some respects. We are not so good in some other respects. Occasionally, we get too complacent, as we did in 2006, 2007, and then the market woke us up. Then we got into a panic mode. But during all those times, I was trading calendars. 2008 was my best year ever. I can't wait for another 2008. Any other questions? If not, and I would suggest very kindly that you go to the link that Tom has placed at the very beginning of the chat and sign up. If it doesn't work, you can always cancel. We have done so far 5 trades, five Kevlar trades. The first 2 that we closed down has already made money. The other 3 that are still on are in the money right now. And from 26th of June to 7th of August, which is about 40 days, we have, using the bare minimum number of contracts, we have made more than $1,000. Here's the question. No, sorry. I've been moving up and down. Yeah, no, that was Tom putting the link in there again. Any other questions?
Looks like one for margin management.
Margin management. Well, in our case, margin management actually becomes even easier than otherwise because of the amount of credit that we take in. Like the trade that I just showed you that we would do, overall your margin, again, it also depends on whether you are trading this in an IRA or you are trading this in a Reg T account, or if you are trading this in a portfolio margin account. It all depends, but what happened to our trade? Did I cancel it? What was our trade? 2040, we said -8 here, 2080, and then down here we had -10 and 10. And let me say start a new trade. So in this case, our overall margin is $19,486, and chances are that we probably won't go above, say, 25K at the most. That's not actually a good thing about the Kevlar trade. Your margins really don't increase too much because you have already taken in enough credit, and especially in a portfolio margin account, this whole thing will probably be a margin of about 6, maybe less. Okay, Ed, go right ahead. Talk to you later. So you think you are from HK? HK, you are from Hong Kong? Okay, in that case, you probably can have a portfolio margin account. We are not an IRA probably, but if you have a normal Reg T and a portfolio margin account, then, and again, remember, as I said, if you have less money, then don't put this trade on. Instead of 10 and 10, put 5 and 5 and 4 and 4. If you have even less than that, then, put 3 and 2. So what I do is I will be sending out an alert which will probably be the smallest margin possible. But if you want to add more to it and would rather just focus on 1 or 2 trades properly instead of having 5 small trades, then, instead of having like 2 and 2 contracts on each side, you can have 6 and 6 or 10 and 10 or 10 and 8. I mean, I already just gave you more or less the conditions that we need to have once we place the trade. This is how our Greeks should look. How many adjustments? Well, that will depend on how the market moves. If today the market just stays at 2070 for the next 10 days, we will have made our 10% in this trade without a single adjustment. Which is another thing, like usually without any single adjustments, which is very rare, obviously, I normally will target about 15%. One adjustment, I will bring it down to about 12. 2, we are now down to 10. 3, maybe about 8. But anything more than 3, I'm happy if I get 5 or 6%. And if I already made 5 or 6%, even though I'm in the trade only for 10 days, I'll just get the hell out. Because remember, if the fact that the market is gyrating so much and you actually had to do these many trades probably means that it's going to continue doing that over the next few days. And again, depending on how good you are at reading charts, you can say that, okay, this could go all the way. Here's the fun part. We are at the 200-period moving average, and we are also at the lower Bollinger Band. So the chances of this thing bouncing up and touching the upper Bollinger Band is pretty high right now. 10% per month is not at all unreasonable to expect. It is extremely doable. But again, as I remember, for some of you who have known me for like about the last 7, 8, 9 years, have heard me say this before. Most of the times, most of us are actually very reasonable human beings. But when it comes to trading and money that is put on the line, we tend to have rigid expectations. And we become very lax with our own trading rules. I very humbly suggest to you that you turn it around. Be extremely rigid with your rules and be very, very flexible with your expectations. Don't just say that, hey, I put this trade on and therefore I have to make 10%, because if you have that mindset, the market will come and whip you and whip you and whip you until you will just give it all up. Trust me. I've been there. You know, when those big spiritual gurus talk about surrendering to the universe, I wouldn't go so far as that, but when it comes to the market, remember I just said it the other day. When you are trading with the market, it's a dance. And the market leads. You follow. Never try to lead the market when you are dancing with it, because it'll just crush you and then go dance with somebody else. Makes sense? Good advice. Well, thank you. Okay, so any other questions? Any other suggestions, complaints, ideas?
I think that, and we're coming up on an hour, so it's probably a good time to wrap it up.
Really? I've been talking for a whole damn hour? Wow. Feels like 10 minutes.
Time flies when you're having fun.
That's very true. I can't believe that you did 5 Kevlars in like 40 days.
If you are interested, there's a link on the members website, also in the chat, and I'll also put it on the library recording if you want to sign up and continue receiving the Kevlar alerts, and the pricing's pretty straightforward. I'll get a better sales page up that has more information on it probably over the next week, but the link that you have right there does go to the page where you can pick what subscription you want and go ahead and sign up.
Okay. You're very welcome, Ron. And thank you all for showing up. I do hope that you learned something. And also, and this is a standard rule of mine to always mention this on a Friday, do not drink and drive.
Good advice again.
Yes. And all of you have a very great weekend. Most of you already have my email address. Should you have any further questions, feel free to email me. Some of you even have my phone number. Feel free to call me. Quite a few of you know my Skype moniker, so feel free to Skype me. I am perfectly fine with any questions that you may have. Any suggestions or complaints are also welcome. So until we meet again, I bid you all adieu.
Thanks, Himanshu, and you can go ahead and end the meeting whenever you like.
Oh yeah, that's right, I'm in charge.
You're the host.
All right, see you guys. Phone number, you want my phone number? Okay, I'll give it to you. Ted, T.R. Phillips, if you are the same Ted, come on Skype, let's chat. Or you know what, if you want a number, I'll just put it down here. Do not abuse this number. Okay? I'm putting this out with enough faith in the human nature that you will treat me fairly the same way that I have been treating you all. So the number is out there. This is my cell phone number. So do not abuse it. By the way, I'm also on the East Coast, so make sure that if it is 9 p.m., you know, in LA, don't call me because it's midnight and I'm probably asleep.
Very good.
Thank you, Ted. I have won $1 million lottery. Okay, that's good. Then you can give me a phone call even in the middle of the night, no problem. See you guys. Have fun.
Thanks, Himanshu.
Okay, bye.